for tax reform for Americans overseas to make it easier and less taxes for us all at the end, even if that tax isn't a compliance cost, being in London and given the history of the Boston Tea Party. I thought the irony of that would have been quite nice. So next time. But so yes, please do respect the policies of the club because they are so gracious to host us here. And also a thank you to some of our volunteers and our sponsors and donors who made tonight happen. Sarah Elliott, our chair of Republicans Overseas. Drew Lickerman, who's many of you RSVP'd to. He is our chair of Republicans Overseas Scotland, as well as one of our most famous spokespeople and our club secretary. So Drew came all the way from St. Andrews this morning just to be here today and is on the sleeper train going back. Only a university student can handle that. And thank you to Helen Berghoff, who she has her new website up and running, expatfinance.com, where I know many of you found out about tonight's event through her website. So it's fantastic to have her covering this event and writing up the event for us so we can share and create more awareness about these issues in the global community. And as well as Stephen Egginton, who's the Director of Politics UK, who's graciously donating a couple hours of his evening to record this event for us. For those who cannot be here tonight. And if you do not want to be on camera and want to ask a question later, just please let us know and we'll make sure that you are not published in the final video that goes on YouTube. So thank you to Stephen for making that possible, and also for some of our friends and community members who couldn't be here with us tonight, because I understand it is a very important religious holiday in certain religious communities, with it being Yom Kippur. So to those who are here, thank you, and yes, now on to the show, right? So what you're all here for, Mr. Solomon Yu, who is the global CEO of Republicans Overseas, is with us, and then as well as John Richardson. They're going to share some of their insights. John Richardson is of Citizenship Solutions, that's a tongue twister, and a Canadian-based lawyer. And these two gentlemen have been fighting the good fight for us all. There are 9 million Americans overseas. We are all impacted by these same issues. It is not Republicans, it is not Democrats, we are all Americans, and we all share in the same challenges of these onerous complications when it comes to citizen-based taxation and some of the reporting requirements that go around it. There are, you look at some of the statistics. In the US, it costs on average $200 for somebody to file their tax returns. Overseas, that average raises to $2,500. That cost is a tax in itself. When the majority of people don't even end up owing taxes at the end of the day, and they have to pay that amount just to be able to get the support that they require to file those taxes. What we've seen as well, since 2010 and the enactment of HECA, we've seen renunciations of citizenship skyrocket. Not necessarily because people even wanted to renounce. People are proud Americans. They want to keep their citizenship. But their financial futures and ability to operate a business, ability to hire more people, is just completely crushed by some of the requirements of having that responsibility. So I'm so delighted that Mr. Richardson and Mr. Yu have traveled all the way here from Oregon and Toronto to share with us their insight of how we can potentially fix these problems for 9 million Americans living overseas and ultimately save US citizenship for many of these people. And then we'll be joined by our panelists, Andrew Grossman and David Treitel, and then open up to a Q&A at the end. Thank you.
Thank you, Erica, and thank you for organizing this event and a wonderful turnout, and thank you for coming. And I'm here to share good news. The good news is we are going to introduce territorial taxation for individual Americans this fall. As a matter of fact, this bill is not going to be part of Tax Reform 2.0. The reason it's not going to be part of it, actually, we got locked out. We were at a drafting stage, and without John Richardson, we wouldn't be part of writing process. And with his expertise and his help, and we become part of it, writing process. The reason is so many issues to consider. And one of the issues people come to us all the time is how you're going to deal with PIFIC. So in order to deal with that issue, and we had to actually talk about what kind of people actually got involved, investing overseas, and get caught in this, PIFIC thing. Actually, I'm going to deal with this later. Let me give you an overall view of territorial taxation for individual Americans, TTFI. When we are successful with this bill, Congressman George Holding, many of you know who he is the chief sponsor. And on the Senate side, we would have a banking chairman who is willing to help out to be a chief sponsor for a companion bill. That makes life easier. And basically take the House bill and do a duplication and turn it into a Senate bill. And bipartisanship is a must, because this is not a Republican issue, not Democrats issue, not independent issue. It is American issue, okay? And then on top of that, we're looking at what is the root cause of FATCA, citizenship-based taxation. We got involved in FATCA lawsuit, take the case all the way to US Supreme Court. And we had 7 plaintiffs, including Senator Rand Paul is one of the 7 plaintiffs. And government for us claim we actually do not have standing. Standing means one of your plaintiffs got to receive a IRS letter. And in that letter states, if you don't pay up what you owe on FATCA penalty or FBAR penalty, we can go after you, take your holding, seize your accounts. And none of them got that letter. So government lawyer basically said, we have no standing for the FATCA lawsuit. So we take the case all the way to US Supreme Court, and US Supreme Court decided not to hear the case. Then we realized we need a new plaintiffs. Now, when that happened, at the same time, there was a candidate for president and running on bring US corporation profit park overseas home under territorial taxation for corporations. So same Jim Bob and I sit down with candidates, campaign manager, say, okay, your candidate, that was before he even got nominated. Your candidate is running on TTFC, and we want to do a TTFI for individual overseas Americans. And we want to be able to ride his coattails, okay? So based on that, last year, we were part of territorial taxation for individual and for the tax reform 1.0. The problem was, it's so complicated bill, TTFI, and on top of it, 1.0 moved so fast through Congress. 1 week in the House, next week in the Senate, done. We could not get a JCT, Joint Committee on Taxation, to score the bill. No score the bill, no debate, and you can't move the bill forward. So that's why we were not part of tax reform package last year. Now, in December, and we realized we need to come back immediately and get ready for this year. So I had an opportunity to have a conversation with House Ways and Means Committee Chairman Kevin Brady. And he actually realized Americans overseas really need help. You have lots of Americans renounce their citizenship, and they couldn't get their mortgage renewed, and they couldn't get their bank accounts opened, and they can't even get corporate managerial positions with check signing authorities. Those are real problems. And also FATCA, FBAR, enforcement and compliance costs are getting higher and higher. And you reach a point you say, okay, what can we do? What should we do? Then I told Chairman Brady, I said, Mr. Chairman, the real issue, the root cause really is citizenship-based taxation. And we have a vehicle. The vehicle is territorial taxation for individuals. And last year, with your help, we were part of it. But JCT did not score it. So here's the deal. I go overseas, sell the concept to Chamber of Commerce, right? And also to grassroots organizations and bring endorsement home. And you guys get the bill drafted, get a bill scored, and get the bill introduced this fall. So here's the deal, that's why I'm here. And during that process, you learn so much from guys like you, what needs to be done. Okay, the overall view is that when you choose, you elect yourself as TTFI qualified, two things. You don't have to file for tax return anymore. And you don't have to pay Grossman tax anymore. So basically, it's an end of double taxation, okay? Now, change 154 years old, citizenship-based taxation law is not that easy. And on top of it, you got a FATCA, you got a FBAR, you got all kinds of issues, including PIFIX. Then come back is the issue how we're going to deal with that. In order for you to elect citizenship-based, territorial-based taxation, you have to be 3 years in compliance. And also you have to have foreign source income only. That's a very important concept. And if you got US source income and you still have to file for tax return and you have to pay tax on US income. And last thing is we find a way to pay for the bill. That's a very important concept. And if you can't pay for the bill, my buddy Rand Paul will not vote for this bill. As simple as this, okay? So how to pay for this bill? Since we're going to go to territorial taxation for individuals and you are no longer file for tax return and you don't need foreign earned income exemption anymore. And you don't have to take deduction on foreign housing tax allowance either. Now, the minute we figure out how to pay for this, life is much easier. And everybody realized, okay, we can solve this problem and getting closer and closer. Last one is that we told Senate and House and White House, this one should be viewed as Trumponomics. Here's why. Right now, for American multinationals, they no longer hire Americans working overseas. That's a matter of fact. The reason is American company would pay 40% premium to hire Americans working overseas because double taxation. You have to compensate them. And because difficulty to getting banking account and living standards higher, all that. And for that reason, it's cheaper to hire this Canadian and sorry, John. And all Indian, for God's sake, right, to work overseas. But we truly believe more Americans working overseas translate into more goods, services used by Americans overseas. And that means creating export sector jobs at home and bilateral trade between UK and US. So if that is good enough for corporate America, for Trump's 2.0, okay, tax reform, it's time to end double taxation for overseas Americans. Now, I'm going to save my rest of time for Q&A. Let me introduce my colleague, John Richardson.
So, where to begin? I love coming to London. I find myself coming here 3, 4, 5 times a year. I was over with Solomon. We were doing a bit of a tour of the Parliament. And I saw this big statue of Winston Churchill. And, you know, I remembered, I think probably you will remember as well, that his mother was American. And I got to thinking, because, you know, I knew I was coming over here tonight, what might that mean for Winston Churchill in today's day and age? Imagine. Yes, work with me here for a minute. So, born in the UK to an American mother, presumably having met the 5-year requirement, do you realize that if the same thing were going on during that era that is going on today, every aspect of his life would have been ruled by the Internal Revenue Code of the United States? Okay? When I first started working in this area, which really coincided with the huge panic of 2011, the Obama reign of terror, where all of a sudden a 1970 law which required reporting a foreign bank account, it was never contemplated to apply to Americans, with a $10,000 floor, if you can imagine, was rolled out, and Americans living outside the United States were threatened with this and led to believe that they had committed the most egregious of crimes against homeland America. And not only that, but it was perfectly right, just, equitable, and perhaps necessary to confiscate their assets because of this. Okay, I mean, this was, you know, where the rollout of this began, you know, certainly in Canada, where there's estimated to be at least 1 million people deemed under U.S. law, regardless of their views of the situation, to be American citizens subject to this thing. But what's going on here is the imposition of essentially, it's way more than taxation, because a lot of people, as Solomon pointed out, do not actually pay tax, but a forced lifestyle that prohibits people who agree that they're Americans abroad and who feel that it is their obligation to obey American laws. They are essentially prohibited from having any kind of normal financial and retirement life. How many would agree with that? You got it. You got it. And by the way, for those of you who think it can't be that bad, if I understand it better, it will get better, that's what I thought back in 2011. And every day that I work in this area, every day that I help more and more people to try to, you know, somehow get out of the end of the tunnel, I find it gets worse and worse and worse and worse. And the answer, and now you might ask yourself, why is this? Well, because first of all, what happened was that in 1967, this is much more about citizenship than about taxation, which actually was more my port of entry into this, because as a long-time American abroad, I had a wealth of experience with the whole loss of citizenship area, particularly during the 60s, when it was the position of the U.S. government that if you became a citizen of Canada or another country that you would automatically lose your citizenship. Yet, flash forward 2011, that you actually have law firms and accounting firms who are taking the position that these people who were stripped of their citizenship under U.S. immigration laws for having become Canadians or some other nationality, in some cases were regarded as inexcludable aliens under the immigration laws, were now all of a sudden reborn, phoenix-like, to be U.S. tax citizens with their assets subject to confiscation and a theoretical requirement that they should have been filing taxes, FBARs, and everything for the last 40 years. Now, obviously, if you're, when people hear this the first time, I mean, it is so frightening that, of course, they, lose their sense of reason. And then they think, oh my God, this might really be true. And there is no shortage of people in the legal profession and accounting professions who will, are perfectly happy to perpetuate this. But the point here is this, okay, that it's very much a citizenship thing. And in 1967, the Supreme Court of the United States handed down a decision that basically allowed dual citizenship. You see, this was not a problem when people could only have one citizenship, because really, just to pause here for a minute, now, how many of you are here tonight because you consider yourself to be Americans, correct? Put up your hand if you consider yourself, that's right. But I'll tell you something. Most of the people who are affected by this do not consider themselves to be Americans at all, because what we have referred to as citizenship taxation tonight includes that, but I think that's a way of describing it that actually invites discussion about whether it's reasonable. What it really is, plainly and simply, is the United States taking the position that it can impose worldwide taxation on people who live in other countries, are tax resident of those countries, and do not live in the United States. I mean, this is shocking. All right, it is shocking. I mean, it is so shocking that almost nobody in the United States even believes this is going on, and those who hear it don't believe it. They say, you're making it up. How many believe you might be affected by the transition tax? You know what they'd say in the United States? I'm not kidding. No, you're making it up. Okay, not so at all. I mean, part of what's going on here is the people who are most affected by this, interestingly, are not in this room tonight. They're the people who, for whatever reason, are deemed to be American citizens and are caught up in this and are being identified through the whole FATCA thing, the bank account thing, the place of birth, et cetera, et cetera. There's very, very little they can do about it. I mean, the bottom line is, I think, plainly and simply, that it's time for the IRS to stay home. Okay? In all seriousness. And I would say this, that I bet you the IRS would like to stay home too. I mean, can you imagine being charged with the problem of trying to apply in what's really now an ancient, out-of-date, archaic tax code that bears no relation to most people's lives anyway in the 21st century, even in the United States, to actually apply this, outside the United States? I mean, if the IRS could be a political organization, they'd be sitting here right beside Solomon tonight. Okay, that is my guess. Yeah, this is so outrageous. So, after a great deal of work on the part of a lot of people, most of who are not here tonight, and Erica made the point at the beginning that this is a bipartisan thing. Absolutely. In fact, some of the people who've done the most work on this would be American citizens abroad. I mean, I know every group is maligned to a certain extent, having not done enough, but they've been at this for years. Okay, I know the Democrats abroad has actually proposed RBT. I mean, this is a problem that unites everybody, and even more than the people in this room, the people who do not see themselves as Americans are caught up in this and are essentially being used as a mechanism to siphon income that's sourced in other countries out to the United States. I mean, the way the exit tax works is it creates a fictitious tax event which actually confiscates capital from outside countries to the United States before the source country has the right to tax it. The transition tax, the same thing, a fictitious, and you know why they have these fictitious tax events? Because the truth is that because of foreign tax credit rules and things like that, most Americans abroad, it's a huge compliance thing, et cetera. They don't pay tax, but I will tell you, the ones who do pay tax, pay an awful lot of tax. Okay, there's no sort of, sending them $3 sort of thing. All right, it's either nothing, or a good deal. This has basically got to stop. If this continues, I mean, my personal prediction on this, and I said in 2011, I said renunciation is going to go through the roof. People said, oh, no, nobody would ever renounce U.S. citizenship. Now it's to the point where people can't keep U.S. citizenship. It's got to be, as Erica points out, a matter of survival, okay? Unless you don't file the taxes, right? I mean, that's the solution. You don't file a tax. I think certainly an awful lot of people don't file the taxes. And the people who do file them, welcome to the transition tax. You know, this sort of stuff, right? I mean, it's a very, very serious problem. Okay, so where we are is on the cusp of getting some legislation that would essentially, in the days of the United States, imposing taxation on non-U.S. income, all right, you know, for people who live out of the United States. And that's, you know, how you want to see it, okay? Whether you call it territorial or something else, I think it's the concept that is important. And in a minute I want to introduce the other panelists, and I want to get some discussion going, but I want to make one other point here before we get going, and this is really a plea to you in this room and the people who are in your networks and communicate with. I never would have imagined that it would be as hard to get these changes as it is, okay? I mean, there's tremendous credit, okay? I mean, you know, he is living proof, okay, that when they say no, you just go back, okay, and keep trying. And that is what is going to happen. I mean, this is possible, but the point is that you people cannot leave this to the small group of people in this world, which is probably under about a dozen people, all right, you know, who are actually, you know, actively going out and, you know, sort of fighting this battle. I mean, you've got to get involved at the very least in making it clear what your views are on this, how this is destroying your lives. You cannot let your lives and your response to this be driven by fear, okay? I mean, the United States is a country that operates primarily on threats, fines, penalties, fear, etc. You cannot succumb to that. You've got to have the courage to hold up your hands and say that this is intolerable, this is unfair, this is unjust, and how this is really affecting you. Because I think that the only thing that could keep us from winning this is if there's a perception that the only people fighting this, you know, is this small group of people. So you do have an extremely important role to play. Now let me introduce to you the two panelists. And actually, it's kind of interesting being here tonight because I know everybody on the panel, so I almost feel like this is a sort of a reunion. Okay, but I guess for no reason, starting with David Treitel. David is a well-known U.S. tax preparer. I think you were an enrolled agent, correct? I got that right? Okay. In London, but regardless of the designation, he knows how to do this stuff, okay, which is the key point. And I would expect that he will have a number of comments to make on the problems of the taxation and how, in particular, a shift in this way will affect his job and role as a U.S. tax preparer. Because what this is not, you know, the point is, okay, that it's certain types of income, you know, the non-U.S. income would no longer be taxable. And this is about the third time now that I've had the great privilege of introducing Andrew Grossman, who's probably the person who you know least on the panel. I think of Andrew as the person who knows the most about the intersection of tax and nationality, probably in the world. I don't even think there's a close second. Absolutely what I would call a lawyer's lawyer, okay? You know, and sort of a class by himself. So, great pleasure introducing David and Andrew. And I think what I'd like to do now is get some intro comments from Andrew and David, perhaps not as long as Solomon might have been, so we can get the Q&A, the discussion going. But Andrew, your thoughts on this?
Well, the astonishing thing is the number, millions of Americans abroad who didn't know that they were nationals. Because the U.S. nationality code is so arcane. Until last June, it mattered whether your parents were married. There's a beautiful article written by the vice consul in Tijuana that you can find if you on the internet in the Foreign Service Journal, and if you just type in Foreign Service Journal Tijuana, about how you could have siblings where one sibling is an American citizen and the other is not, simply by the accident of whether the parents were married, when they were married, how many days they stayed. And then last year, Justice Ginsburg invented a new nationality law by saying that it's unconstitutional to treat non-marital children. And I can say from practical experience that one of my grandsons, who is British, would be American citizen if he were born after last June 2017, but isn't because he was born in 2013. That's the arbitrariness. But the shocking thing, of course, is that when people are told by their banks that we're closing your account because you're an American, and they say, but no, I'm not. Like Boris Johnson, they might have been born in the United States by someone who was there just temporarily, or perhaps under certain circumstances. They might have a father who abandoned the family, but who was a GI. There are any number of ways that you can be a U.S. citizen without ever having had any contact with the United States or with the U.S. Embassy. And one area where I've worked is in trusts and estates, where there is a terrible conflict when an American citizen passes away in Britain. And even worse in Canada. There was a 10-year period when American Canadians' estates were taxed double, once as a capital gains tax and once as estate tax by the United States. And the fact that it went on for 10 years and nobody cared is part of the trouble that we're having and discussing tonight. That tax treaties are often quite accidental. There are only 4 countries, of which Britain is one, where pensions under Article 18 are free of what's known as PFIC and double taxation. Taxed by the United States when you put the money in, and then taxed by Britain when you take the money out. I think I'm taking time.
Well, we'll be back to those issues, but I think one thing that, I think perhaps comes from Andrew's introduction here is that for those, if you know people who are caught up in this, so-called, oh my God moment, sort of thing, the starting point is, are you or are you not an American citizen, okay? And, there's American citizenship for nationality purposes, but since 2004, there's also been American citizenship for tax purposes, right? Which is somewhat different. Anyway, important inquiry. David, your thoughts on this?
So, thank you, John. It's quite interesting you're talking about nationality, and I shall bow to Andrew's knowledge on this, but whenever I meet a new client, I go through 3 stages. The first question I ask them is, are you American? There's absolutely no point talking about US tax if they're not a citizen of the United States. The second thing I do is explain why that matters, and it's worldwide tax, which is not difficult to say, not too many words. And the third thing we then talk about is possibly how to catch up with form filling. But to go back to who an American is, you mentioned earlier in your opening remarks, John, Winston Churchill, who, as you said, was born to an American mother. Now, at the time he was born, that did not make him American, but later in life, JFK kindly gave Winston Churchill honorary American citizenship. And I've often wondered whether that gave Winston the opportunity to pay tax in the United States.
Well, David, as far as I know, the IRS will accept any payment from anybody. Questions asked.
So if you move to slightly more modern times, we've had the benefit in the last year of a wonderful momentous event in London. We've had the wedding of Prince Harry and Meghan. And Meghan has said to the tabloids, reportedly, that she would like children. Those children will, under US law, be citizens of the United States, whether or not they ever visit the United States or are able to visit the United States, subject to tax. And so we get the curiosity of US tax extending to people who may have very little obvious connection to that country.
You mean the opportunity of US tax?
There's the concept of US person, which you didn't mention, which is you might have not have the right to enter the United States, but you have the obligation to pay US tax.
No, actually, this is an extremely important point, okay? you talk about U.S. person. Well, we're looking at this from the point of view of being U.S. citizens. There are more people caught up in this residence who can, either have a permanent resident visa, green card, or meet this so-called substantial presence test. But let's look at the green card situation for a second, because of separation of immigration laws, meaning the right to live in the United States, and the tax laws where it may not matter. It's absolutely correct. You can have people who have lost the legal right to live in the United States, but still be completely subject to every aspect of the tax code, if you can imagine. It's the American way. What's that?
I think an example might help.
Well, go for it.
I'll give you an example. So, a couple of years ago, we met a lady who was happily married. Husband was late 70s, but sadly losing his eyesight. So the husband was British. He wanted to go and see the Grand Canyon, Empire State Building, tour the United States while he still had eyesight to see those wonderful sights. In an earlier life, in the early 1970s, the lady had a first marriage to a US citizen. The marriage was a disaster. It was abusive. She left the relationship, flew out of the United States without telling the husband she was leaving. She had the misfortune of having a green card. At the time I met her, the only way of curing the problem of tax was filing tax returns for a country which had lived for maybe 6 months, a year, how long the first marriage had lasted. So it's a very strange thing, the green card test. Unless you properly abandon it, tax law says you're still a tax resident.
Yeah, was that prior to 84? I thought that kicked in January 184.
So I'm not going to argue dates at this moment.
Yeah, well, I mean, it is important, okay, because my point is simply this: that it's an ebb and flow, right? And you can have a significant change in legislation that kind of locks people into this or not. Okay, so I mean, I think it's pretty clear that that this is a major problem. Actually, when it comes to either U.S. citizenship problems or U.S. tax problems, there is no such thing as a small problem. All right, I mean, I think that's pretty clear. I think what might be a good idea here is to get an outline of sort of the Reader's Digest, or maybe proposed TTFI for dummies or something like that. And I'm wondering, I think I'll turn this over to Solomon to answer, but I'm wondering if we could recognize that there are rules for people prospectively leaving the United States, and then there are proposed rules for people already outside the United States, right?
That's correct.
So how about if, Solomon, maybe you give the proposed rules for people who are in the United States, that maybe I'll do the transition thing, and we'll get a comment from David and Andy.
Sure. It goes back to what we talked about, how you handle difficulty. And during that process, we said we have to really think about what we're going to do with Americans already invest in their own retirement overseas. And they're working out there, and they're living out there, and how we treat those incomes. Negotiating with House Ways and Means Committee and JCT is not that easy, okay? Because they have their concerns, and some of the concerns are legitimate concerns. For example, their concern is after TTFI passage, we don't want Americans, homelanders, wealthy, and try to game the system. Basically, they move money overseas and claim TTFI status. With that, they don't pay any tax on anything, all right? So the real issue discussion started. What is acceptable and reasonable and fair to you guys at this point? We raise the issue. For example, those Americans, their host government mandate to invest into retirement fund, retirement plan and pension plan, whatever you call it. And they have to put in percentage of their monthly check, and their employers also put in whatever percentage. And those guys invested, let's say 20 years, 30 years already. And obviously, when you do a transition tax, we're talking about now, this time, it's not exit tax, it's a transition tax, okay? And will be so-called deemed capital gains. They can't even pay for that because they're not ready to retire. They can't take the money out, right? And they can't even borrow money to pay for this. How are we going to handle this? Should those people to be exempt? By golly, it worked. They say, yes, that's very reasonable. Those people have to be exempt. It really took care of lots of people out there already. So you have the first step then you realize, let's talk about what their concern, we already know what their concern is. Rich people, stateside, game the system, okay? So next step is that take one more step further. If that is the case, that is your concern, how about we do this kind of deal? Existing expats versus new expats, right? The existing expats, they doesn't matter, government mandate, or they decide on their own to invest in retirement vehicles. Should they be exempt, those guys, right? And the new expats, after TTFI, okay, then their PIFIC investment vehicles will be treated as U.S. residents, not non-U.S. residents for tax purpose. That seems to be a reasonable solution. Of course, you know, you always have somebody say, well, that's not fair, and you segregate again between existing expats and new expats. So wind up, we put a third proposal on the table. Basically is, how about exempt anybody invest in foreign mutual funds? Actually, that's John's idea. It's not mine. I can't take credit for that. But they will solve majority people's problem. At the same time, no wealthy individuals are going to take their money, invest in foreign mutual funds. They don't have control of the money, right? So we have three proposals on the table, and they have not rejected any one of them. However, that is the cause of our delay. Because this delay, and we have opportunity to pull ourselves out of tax reform 2.0 package, okay? Now, let's talk about deemed capital gains tax. The concept like this, we want to be able to fix transition tax problem for overseas entrepreneurs, right? I will talk about that problem later, okay? Then, first of all, we have to connect our TTFI with TTFC. In order to connect both, because TTFC, guess what? That is a transition tax. Not like your renunciation, there is exit tax. So for TTFI, when you elect to be TTFI qualified, we have to do a transition tax as well. Then the issue is, okay, how are you going to deal with this TTFI transition tax? Again, it's the same issue. You talk about property, your home. You bought 20 years ago, 30 years ago, right? You already got lots of capital gains. So they were kind enough. Say, all right, we throw in 5 million, okay? And as exemption, anything under 5 million, you're exempt. So call John, say, John, they offer 5 million. He says, Solomon, you're in US, Salem, Oregon. Everything is cheap. I'm in Toronto. Okay, think about people in London, in Paris, in Rome. Okay, and 5 million is not enough to cover anything. All paper money. All right, and you don't want people like us sell the home and to pay transition tax. So I went back and said, look, here's the reality, okay? So what if we double it? So now the transition tax exemption for deemed capital gain tax is 10 million. So two tests, two triggers. One, 3 years compliance we're talking about is that for people got a tax liability for 3 years at $165,000 a year for 3 years, and most middle class will not be in that range. Then you go to next test, which is your overall deemed capital gains tax liability. So that 10 million will cover basically your home, if you have a rental home, your rental home, and your investment vehicles, whatever you got up there. Then also maybe you got a boat, whatever, right? So that 10 million covers. Now, suddenly, most people will be qualified for TTFI. Also, we have to deal with another issue. John came to me and said, you know, lots of people are not compliant, not because they don't want to pay US tax, and they don't even know there is a liability. And so what can we do about that? So I went back to start another conversation. The conversation is for accidental Americans, let's say, for dual, and they're not in compliance. Now, since he is a lawyer dealing with renunciation side, and I asked him, what is the cost for somebody to not renounce citizenship? 5 years tax compliance to begin with, right? Then you have to pay FACA penalty, FBAR penalty, then 2,300.
There's an administrative check.
Yeah, 2,350. And what is the bill? Average bill, 4,500 to do this kind of work, okay? To finally to be free. Problem with that is most people can't afford it, okay? And the rich, we don't have to worry about them. They can take care of themselves, right? Middle class can't afford it. So we go back, say, all right, here we really need a deal. We need to encourage more people to be TTFI qualified and to come into compliance. So the way they come into compliance is 3 years, okay, we negotiate without FACA penalty and without FBAR penalty. You can't get any better deal than this, right? And on top of it is the issue 4,500 or more, depends on your jurisdiction country, to do this kind of work. So if you do a streamline compliance for 3 years, okay, how much will it cost? So when I went to Toronto to do the same deal like this, and he introduced me to 3 CPAs, and they were charging 1,500 Canadian money for 3 years compliance. Now, suddenly, we can offer dual citizens and accidental Americans the kind of opportunity to get out of this. And the end game really is save citizenship. Let me explain to you. One of my 7 plaintiffs was a gentleman, military vet, and served U.S. Army, and as a IT person. .com crashed, moved to Switzerland, married a Filipino nurse, and happily after thought, you know, everything is cool, got a real good paying job, all that. He is on every 3 years to renew his mortgage. And Swiss was under the gun, right, during FACA. And he got a letter said, we're not going to renew your mortgage because you're U.S. citizenship. So he had to renounced and got his citizenship renewed, but got his mortgage renewed. But that's not good enough for IRS because he renounced first before IRS sent him an ugly letter. Okay, so he didn't have standing in our case. All right, but because he worked so hard, we recruit him as one of the witnesses to testify in U.S. House on FECA issues. And he put his uniform right next to, on the table and right next to him. And I made him a promise. Whatever we do next stage, including TTFI, we will find a way to take care of your daughter. Now, his daughter's situation is 12 years old, okay? And the Swiss government allows you to open a college savings account. And you can put pre-tax money in it. And Swiss government will contribute percentage, whatever the amount, into that money. And she can't open one because her father renounced. If her father opened a joint account with her, her father had to file FECA, FBAR, everything. You drag father back to the reporting requirement. And father said, no, there is no way I can come back and do this and violate my privacy rights. Again, I had enough of this. So the issue is, he said, you know, I worry about my daughter. So I said, you know, Daniel, one thing we're going to do, whatever we do for TTFI, we will make sure when your daughter turns 18, she's automatically qualified for TTFI. When we shared this in Toronto, and lots of people in the audience suggested, you should turn this bill into Saving American Citizenship bill. So, then back to you.
Okay. What I'd like to do is this, because we do want to get your questions, absolutely. Okay, I want to do a very succinct, I just want to elaborate on a couple of small points he made. Then I'd like to hear from David and Andy on what they think about this briefly, and then we'll let your questions drive it. Okay. So in a nutshell, okay, it's this. What's being proposed is foreign income no longer subject to U.S. taxation. Okay, we've got that far. This needs to be viewed from the point of view of people who are already in the United States and people who are leaving. Now, the bottom line is this, that for people who are in the United States, if they want to transition to becoming a qualified non-resident, which essentially means that although they're still a U.S. citizen, they're not subject to tax on non-U.S. income, they would pay a departure tax upon leaving the country. Okay, which is sort of a deemed disposition thing.
Transition tax.
Yeah, transition tax, okay. It's analogous, though, to what's called a departure tax in other countries. The point is, by transitioning to a different tax status, they would pay a deemed disposition capital gains tax on their non-U.S. assets, okay? So what does strike me is that they can easily avoid this by planning in advance. The problem, though, is how do you deal with all the Americans abroad who've lived a lifetime, you know, et cetera, et cetera? Are they also required to pay a transition tax? Okay, and the answer appears to be yes, but. So what's the but? Okay, as Solomon explains, people who have less than 10 million of assets would be exempt from this. Obviously my personal preference would be none of these departure taxes, okay, but we're living in a world where transition departure taxes are accelerating, okay, generally speaking. It's certainly not as onerous as the exit tax. I would agree that if all of this works, it does provide an opportunity for people to remain U.S. citizens. Okay, there's nothing that's perfect, but it does provide that opportunity in contrast to what's going on now, which, you know, my view is that these are basically forced renunciations at that point because people can no longer survive. Now, before, I do want to get to your questions quickly, but I'd like to hear from both David and Andy what their views are on this proposal. Starting with David.
Thank you, John. What most of us understand is that our contract with civil society is to pay tax somewhere. Tax is something that we all end up contributing. Having said all that, what most of us would also like is some element of certainty and simplicity. And the current system has no certainty and no simplicity. Simply moving from where we are today, which is citizenship-based tax, to residence-based tax, leaves the opportunity for wealthier people to leave the States and move to some sunny Caribbean or other tax haven. So moving to something with some form of transition tax, departure tax, exit tax, what you wish to call it, makes some sense, and the $10 million threshold is a sensible measure for most, the majority of people.
Andy, your thoughts?
Well, both our nationality law and our tax law are the result of accident. They grew up partly by legislation and partly by court decisions, and they make no sense. So to rationalize them, this is one way of avoiding conflicts. I spent my academic years in something called conflict of laws, and there is nothing more conflictual than tax law and nationality law. The whole history of the United States is based on the concept of allegiance, and that's the way our nationality law was developed. And you owe your primary allegiance to the United States, therefore they should be able to tax you first, and it doesn't much matter what other countries do, unless by accident there's a treaty that resolves it.
Okay, so is the consensus, well, I know what Solomon's view of it is, so I mean, for David and Andy, is it your consensus that this will in fact provide relief for a significant number of people?
I think it will for many. As of now, you have people, the very wealthy and the very poor seem to be less troubled by the kind of tax problems that we've been discussing than the middle classes. And no matter what you do, you can't resolve everybody's problem. I think John is well aware that every client has its own story, and every client has perhaps a solution. So it's a good thing, but it won't solve everybody's problem. Okay.
David, your thoughts? That particular question.
I think that aiming to a solution is good. Does it solve every problem? Are there possible ways in any legislative draft for people to shift money around and avoid it in some fashion? Possibly. So it needs careful drafting, but a better way must be possible. This is a good direction.
All right. Well, I mean, that's encouraging. Okay. So, well, what do you, I mean, in a general sense, you know, show of hands, how many of you do see this as helpful to your situation and the people you know? Not perfect, but helpful. You know, I mean, certainly, I think, a step in the right direction. I mean, it's loosening some bolts that are so rusty, okay, and so rigid. You know, that at a minimum, okay, I think it's a great start. But let's get into the Q&A here. Okay. Well,
let's do 3 questions.
Yeah, we're going to do 3 questions at a time. How about 1, 2, and 3? We'll start with you 3. And if you could stand up so we can hear, that would be great.
Does this bill have anything to do with inheritance tax?
I think the short answer is no.
No. Inheritance tax still is 10.75.
That's not.
There is no inheritance tax, actually.
No, there is if you're married to someone who's not American.
Oh.
Okay, all right. There is nothing in this particular legislation that addresses any kind of estate or inheritance tax issues. Okay. Anyway, sorry, that was we were going to pile on, but that one was easy. Yes.
What income is considered foreign income? I mean, is it income you earn from a job, or is it also if you hold your finances in a bank and it's interest investment income?
Okay, we'll hold that for a second to get another question to add to it. Yes?
It's just simply, what are the chances of this passing the House and Senate?
Okay. Tell you what, let's table that one. Who else has questions on the definition of the excluded income? Definition of excluded income. Okay, all right. Let's, Solomon, you want to start with that?
Yeah. Foreign income. foreign income considered as your jobs, if you have rental properties, London, and that will be considered as foreign income in London, and will be considered as foreign income. But if you have rental properties in US, you still have to pay tax, you still have to file. So from that perspective, foreign earned or source income exempt.
Does that mean like even if your investment income comes, like you keep your money in Switzerland, but you live in the UK?
Oh,
Yes.
that's foreign source,
Okay.
foreign earned
One more question.
income. Yeah.
What about if you own US stocks?
Then you probably have to be considered as
On the US income from those stocks, you probably pay
The
tax.
U.S. stocks are for all purposes
Yes,
treated as
as
U.S.
US income,
It,
yeah.
it reverses, okay, the current rule of the Internal Revenue
Right.
Code.
Which is one.
Yeah, so on this point, just one second, because this, this is sure to come up again, okay? Basically, without getting overly technical, the intention of this is that if the income comes from something that is factually outside the United States, okay, leaving aside fictions in the Internal Revenue Code and that sort of stuff, that would be foreign source. If the income comes from something that is factually inside the United States, then it would be considered U.S. income. All right, and this is just the test to be a qualified non-resident. Okay? Yeah.
Now, I read somewhere that on this guilty tax, I lived in
Yeah.
the UK. And so business income now has this 10% fixed asset exclusion and a deemed distribution. Will that provision go away?
Okay.
Because that's what worries me.
Yeah, okay. How many are concerned about the guilty, the going forward one? Okay. All right, that's like, it's all the same question roughly from the whole group. So why don't we talk about that? But before we do that, how many are concerned about the transition tax? Okay, so 2 of you. All right, okay. Before we get answers, for the benefit of everybody else, okay, I want to clarify what the difference is between those two things, okay? Now, these come from the Tax Cuts and Jobs Act, or rather the Tax Jobs and Something Act. In December, there are many Americans abroad who run businesses through corporations that are not incorporated in the United States, which makes them foreign corporations. To the extent that the share ownership is greater than 50%, okay, and this is a bit of an oversimplification, they would consider to be controlled foreign corporations. Controlled foreign corporations are taxed have always been taxed punitively, at least in terms of their passive income, but going forward, all income earned by foreign corporations was subject to new tax rules. With the transition taxes going backwards, with the guilty taxes going forwards. And the bottom line is simply this, that without relief for Americans abroad on this particular issue, those who are subject to the transition tax may very well be bankrupted if they try to pay it, and those who are subject to the guilty tax might as well get rid of their corporations because everything is going to have to be paid out unless they're using it for another purpose. The transition and guilty tax are complicated issues that are not specifically dealt with in this particular tax legislation, all right? But we're well aware of them, and workarounds on that are coming. Do you want to add to that, Solomon?
It cannot be a technical fix to begin with. The reason is very, very simple. One, Congress used the transition tax as a revenue enhancement, in the sense paying for 1.0 tax reform bill. That means you have to find additional revenue from somewhere else to fix that problem to begin with. So you heard me talking about we can pay for our own tax reform, right? I mean, our own TTFI. But we're not going to use the same revenue to pay for the transition tax revenue enhancement. You can't use the same revenue twice. That's one. Two, problem with transition tax truly is unintended consequences. Let me explain what happened, what really happened. When bill goes through so fast, How many people think congressmen and senators read bills? Show of hand. Okay, nobody. And staff members read bills, okay? But when things going through like this, staff members do not know the difference. I'm going to use Apple Incorporated, wholly owned, operated Apple stores, let's say in London, versus a entrepreneur, expat, independently owned, operate Apple store. They don't know the difference between those two. They thought it's the same thing, okay? So now you got two problems here. One, Apple wholly owned store, after they pay 15.5 transition tax back to 1986, their future earnings totally exempt, no deal tax, moving on, right? However, individual owned, operate Apple store, after you pay 17.5, two more points, extra points, and you are still paying future tax on your foreign source income or profit, whatever. Problem was, how many people here using S corporation? In the States, we use S corporation a lot, so we don't have to pay corporate tax, right? Then all the profit going through either passing through salary or distribution, right? And you guys don't do that. So when I sit down with Treasury, and we did three things. One, ask for extension. Actually now, technically you have two extensions. First extension was 60 days from April 15th to June 15th this year, technical extension. The second extension you got, little muddy, not clean, but you got that, basically no penalty. You can wait until next year, April 15, 2019, to pay first installment. That gave us an opportunity to get a TTFI pass.